Hi, I'm Aaron Klein, a fellow and policy director here at Brookings at the Institute of Business and Public Policy, and it's my pleasure to welcome you here today. We're hosting an event here to talk about how to make financial technology, or Fintech, as it's become, work for working people. It's my hope that through this conversation here, we're going to be able to really delve into some of the substance about this new technology, which has exciting promise to transform the way that all of us in this room conduct our life, our basic financial services. If we'd had this conversation 15 years ago, perhaps the panel would be talking about these new concepts like online banking. And if anybody said 15 years ago you'd be able to deposit a check from your bedroom, you probably would have laughed at them. I know we never thought of that when I was in Congress and we did the Check 21 Act, the enabling legislation to do that, less than 12 years ago. So here we are now opening a conversation on financial technology, and we're going to do things a little bit differently than we thought. For those of you who worked in the United States Senate, like myself, you appreciate the fact that member schedules can be a little bit unpredictable, a little bit unproductive too. Thank you, Mr. Freud. And so I think what we're going to do here now is start with the first panel, which is a group of actual business entrepreneurs and people who are in the space right now talking about financial technology. Then hopefully we'll be joined by Senator Warner to hear his thoughts. And then we're going to close with a panel of government and regulator expertise who are in the trenches trying to figure out how this new coming world of financial technology interacts with our existing world of financial regulation. And I think getting that answer right, if we can do that, we're going to allow the entrepreneurs on this panel to innovate and make our lives a lot better. And we're going to allow the regulatory world to make sure that our financial system is safe and sound, and that the regulations and the implementation, that the products that these folks create work for working Americans. So with that as the backdrop, it's my great pleasure to introduce Rachel Witkowski. Rachel, you read Rachel all the time in the Wall Street Journal, and before that, many of us here read her in the American Banker. She's an expert on the questions of bank regulation and financial technology. It's my understanding doing the Fintech conference circuit quite a bit. So it's our great pleasure to get somebody who really understands these details on an in-depth basis, both from a Washington perspective and a business perspective. So Rachel, please take it away.
Thanks, Aaron. Good afternoon. Welcome, everybody. I am honored to be here. I might have been oversold there, but I appreciate that. It's my pleasure to introduce the panel to you. What I'm going to have them do is each give a brief overview of what they do, who they work for, and then we'll launch into a Q&A and then an audience Q&A. So I'll start from my left.
Sure. Nat Hoops. I run the Marketplace Lending Association, launched earlier this year by Lending Club, Prosper, and Funding Circle, three of the leading lenders that used to be known as peer-to-peer and now are more commonly known as marketplace lenders. And we're looking to grow the group to invite all tech-enabled platforms that meet borrower-friendly criteria. So we're in growth mode and focused on advocacy and public relations here in Washington.
Nadeem Hamsani, I'm the co-founder and CEO at EarnUp. We're a startup in San Francisco. Before I talk about what we do, let me talk just for a second about the problem. There's 200 million Americans with debt, and that debt amounts to $20 trillion. That's pretty incredible. So let's pause there, and $20 trillion, and think about that for a second. And that certainly feels like it's insurmountable, but we believe it is surmountable, and that's where EarnUp comes in. EarnUp intelligently automates the way people pay their loans and gives them savings and gets them out of debt faster.
Quentin Farmer, one of the co-founders of Even. We're based in Oakland, California. So we're looking at income volatility, specifically folks that have substantial paycheck-to-paycheck income volatility. So just as one group that we serve, 70 million Americans work for an hourly wage. Those folks often have a substantial change each paycheck to paycheck. The way Even works is our smartphone app that connects to people's existing DDA or prepaid card. We analyze that account for historical income, use that information to predict what we call an even pay, basically the amount that you'll take home each paycheck. When you earn more than that amount in a given pay period, we automatically save money for you. So it's a time of surplus income. When you earn less than that amount in a given pay period, we send you an advance, a way to make sure that that income is smoothed out and you're able to meet your obligations. So we're still a small team, there's 12 of us in Oakland, but we're currently working with employers to serve their employees as a benefit. And so that's our business model. Employers pay us a flat fee, and there's no cost at all to the individuals that use us through their employer.
My name is David Reiling. I'm the token bank on the panel. I'm the CEO and chairman and owner of Sunrise Banks in Minneapolis. Sunrise is about an $800 million financial institution. It is also a certified community development financial institution by the U.S. Treasury. We're also a B Corp, as well as a member of the Global Alliance of Banking on Values. So very much a mission-driven organization. I would say if you think of us in this fintech space, the reason, the why that we have at Sunrise is we really believe that we provide a greater access to more convenient, transparent, and affordably priced financial products and services. We do that in really two ways. We do that what we call hand-to-hand combat, person-to-person relationships, like you might think a community bank does. But we also do it through business partnerships, like with the fintech organizations that are here. And so that puts us into a very interesting kind of strategic realm. There's really two halves to our business. One is what you might think of from a traditional or place-based type of community bank. We serve the urban core of Minneapolis and St. Paul. A lot of commercial lending for jobs, affordable housing for shelters, and a lot of nonprofit organizations bank with us because we're mission aligned. The other half of our business is really in the payment space. We're in the prepaid card business. We leverage that platform to really help underserved populations access the payment system, as well as we have a small dollar loan product that's responsibly structured that we deliver through employers to employees. If I had to kind of give you the ethos of Sunrise Banks, it's about mission and innovation. We have a unique innovation process to navigate through the regulatory process as well as do business with financial technology companies. In our space, it's a relentless cultivation of new ideas and opportunities, and we filter those, or what we call propel them up or down quick. Then they go into a quick governance process in which we're going to develop how to put them into place in the marketplace. And then, like all new things in life, they need a little nurturing or check and balance. So for Sunrise, on average, we do about 2.5 new product services a year and have since 1997. So it is in our DNA to do this type of thing. So love financial technology companies, have a blast talking to them because of the fact that everything is possible.
Thank you. So my first question to all of the panelists are, what are the real challenges, the financial challenges that the everyday working American faces, and how can fintech be a solution to that?
I'll jump in on on one product that I think most people in this room probably have, and that's the credit card. The credit card market is really dominated by some of the largest banking institutions in the country, and that has meant that even as interest rates have gone sort of to zero due to Federal Reserve policy, credit card rates really haven't budged. And that's created an opportunity for lenders like my three members, the marketplace lenders and others, to jump in with a product that's more affordable for Americans in terms of the rate, and also more affordable because of the structure, because it's a term loan rather than a revolving credit product. And so I think the opportunity to kind of disrupt a core enormous consumer lending, and credit cards are an enormous sector, and I think we're just touched the beginning of what's possible here in the space in terms of helping Americans not just gain access to credit, because again, if you're in a revolving credit card at 24%, you're not necessarily in a product that is, maybe the most cost-efficient way that you can access credit. You have an opportunity now because of financial technology to refinance or choose a product that is much more affordable. And so that, I think, it's not just access to credit in the United States, which I think is pretty widespread. It's access to affordable credit, and that's one of the biggest things that fintech is bringing to this sector.
I'll take a shot. One of the things that we see for your everyday American in this space, and and this doesn't really have anything to do with somebody's low income, middle, or high income. Not everybody speaks bank. Like, not everybody speaks government or speaks healthcare. So the fact is some of the, in my opinion, one of the important things that fintech can do is simplify that, almost like a Google Translate, and the fact that, for example, my daughter who's 17, she has a prepaid card. That prepaid card automatically puts together a budget for her. I had never gone through budgeting with her. Now she can see a sample of it. Now, she doesn't speak bank either, but now she knows what budgeting looks like, and she didn't have to do a thing. She understands the awareness of her account because the texts come to her automatically. So it simplifies a very complicated process in a lot of ways. And I think if we think about this for the average American, is that not everybody speaks the language. Even if English is considered your first language, you still have to speak the business language, no matter what sector you're going into.
I think I'm practically contractually obligated to say volatility in answering this question. And I think this is an issue that is just now starting to get the attention it deserves, especially here in the States, right? So when we started even 2 years ago, there's all of these stories and research that have been done in the developing world on volatility and how it impacted especially low-income individuals. And my co-founder, when we started the company, actually wanted us to go abroad and work on this problem. And my answer to him was, no, we can do this here, just no one else is talking about it, which if you're a founder, that's actually a good thing, right? Because it means you're a little bit ahead of the curve. And since then, I think it has started to get more the attention that it deserves. JP Chase has done some good research on the topic. US Financial Diaries is a fantastic project that has informed a lot of what we do. Obviously, I spend more of my time talking about income volatility, but it's not just income, it's not just paychecks, it's benefits and the volatility that those might bring into your life. It's your expenses and how those change throughout the year. And so I think, in general, whether it's at the financial institution level or other fintech companies, recognizing and really speaking the language of the consumer,
Correct.
which is that volatility is their language, right? And we need to be meeting them where they are in building products and services.
I'll go next. Let's start with a little bit of data. I tend to be data-driven. 75% of Americans live paycheck to paycheck. That's one of the problems. Another problem is that the majority of Americans can't survive a $400 unexpected expense without going to family or some other source of funding. So the problem is pretty. It's a bad problem to have. So where does fintech step in? Well, for us, nobody budgets anymore, and I'm not sure anybody budgeted before anyway. And society is particularly fast-paced now. So where EarnUp comes in is we do the budgeting for the consumer. Not only do we help them set the budget, we actually do it for them. So perfect example of this is if you're one of the 75% of Americans that live paycheck to paycheck and you owe a $1,000 loan liability, let's say it's an auto loan, student loan, and maybe some and a mortgage debt, what we'll do is we'll take that $1,000 and split it into, and you get paid every Friday, we'll take that $1,000 and we'll split it into 4 equal pieces so that $250 is coming out of your bank account every Friday. And we take the consumer completely out of the budgeting game so that they don't have to worry about it. And there's some really interesting behavioral psychology effects that happen as a result of that. So consumers tend to be quite irrational, or said differently, quite emotional about the way that they spend their money. Mm-hmm. So one way to approach that is try to use logic to convince them to do otherwise, but we found that doesn't work. We've all been trying to do that for a long time. So what we use is try to play on their emotional level, which is to use behavioral psychology. And so there's a couple of interesting behavioral psychology things that happen as a result of doing what we do. One is because you're taking the money out along with their paychecks or the way that they're earning their money. What ends up happening is they spend, even though the money's out there getting ready to be paid for their loan, they have less money in their bank account. They feel like they have less money in their bank account. And so as a result, they spend less than they otherwise would. And the second behavioral psychology component, it's called the concept of relativity, is while 250 on that Friday that I talked about, 250 times 4 equals $1,000. Nobody's going to disagree about that. The $250 once a week feels a lot less than that 250 times 4. And so as a result, what we're able to do is get consumers to add just a little bit of extra money onto each one of those payments. So in this case, let's say it's $25 once a week. That $25 once a week feels like a lot less than $100 at the end of the month. And thereby what we do is we accelerate the loan, reduce the amount of interest that people pay.
Obviously, there's a lot of solutions in fintech. On the flip side of this, where does fintech miss the mark in meeting the everyday needs of a consumer?
I can go first here. Fintech does a great job of focusing on particular products, a lot of particular areas. A lot of fintech solutions are very niche. They tend to be focused on particular niche areas. In fact, and niche areas that are focused on urban environments. In fact, many of those fintech products are created by individuals who work in those urban environments. And that's all well and good, but on average, fintech companies tend not to focus on the middle of America from an income basis, the lower middle income group of people. And I think that's a real challenge for fintech entrepreneurs, is to focus on the average American, the hardworking American that's working a full-time job just to make ends meet, or working multiple part-time jobs, and is facing a lot of the typical challenge that the average American faces.
You know, I would chime in, and I think where fintech may miss the mark is fintech is usually geared directly at a specific consumer with a specific need of some kind. And if you're that consumer with that need, it fits very well. If your needs are something different, you might not that might not fit you, and you have to keep searching for the right product or service. In addition to that, some of the missing the mark is product to individual, where some of the instability comes in a person's financial wellness may have to do with the community that they live in. They may live in a more volatile community. That could be a household, that could be a neighborhood, and so as a result of that adds instability. In some cases, there's exploitation in a financial technology realm. So we can see that there are not all good players in the space. And so as a result of that, one needs to be cautious. You know, and I would say the last kind of aspect where fintech, we're having the conversation today around, is how does fintech fit into that political and regulatory space to make it really work for the consumer as well as work for the regulations that need to be complied with?
I mean, I think one thing where it is serving people really well, though, is as connectivity online just increases even further and further and further down the income threshold, and even into some of our most remote rural areas, you have people who might not live near a bank branch but can come across a highly competitive and, at least on the consumer side, very well-regulated market online, and potentially access the best possible priced product for them that they might be able to access, that they wouldn't be able to physically come across without being in a fintech, pursuing a fintech product. So I think it's also important that while there's definitely room for all products and services to continue to improve and try to serve all Americans, it's also important to remember what we're comparing it to. And even in the area of algorithmic lending, we've seen a lot of problems in non-algorithmic lending, right? In terms of people who are coming from protected classes at car dealerships or whatever, not being offered the most affordable product for them, and algorithms that are based on basic information that everybody is consistent across everyone, offer kind of a level playing field that might not exist in someone's community depending on where they come from.
I wanted to spin off of the issue of budgeting. This is an everyday issue of overspending, bouncing the account. There's a lot of technology out there that does stop gaps in preventing people from overspending in their account. How do you balance providing that and guiding them into better financial decisions versus making the decision for them and forcing them into a certain direction within your own products and services?
Yeah, it's always that challenge between paternalistic versus letting the consumer make the decision. There's been a lot of interesting research that's come out of the Common Sense Lab in Duke University with Daniel Ariely and behavioral psychology concepts. And what they have been able to prove through a study of a meta-study of 300 other studies is that the only thing that works in terms of consumer finance education is just-in-time education. There's a number of states, I think 9 or maybe 12 states that have, as part of curriculum requirements, have required students in high school to receive personal finance management training, and that they found that the half-life of that training is anywhere from 6 months, 3 to 6 months. And that's incredible. They spend 3 years in class, and within 6 months, they only remember half of it, and within 2 years, it's all completely gone. And they have some hypotheses as to why that's true, mostly because a lot of people learn how to do financial management through their parents or through their family environment. And so the only thing that works is just-in-time education. And so what you need to do is when people are making those decisions, you need to make it crystal clear, or you need to take the time explaining to them how those decisions impact them. And then you can provide them options. At the end of the day, it's the consumer's option as to what to do, but you can direct them through that education. You can direct them with that just-in-time information to make better decisions. Then the final piece of that is just notifications. Letting people know that they're in a particular situation and allowing them to make those decisions is critically important. And then automation associated with that is really important too.
If I could dovetail off that a little bit on the financial education side, I think in a lot of different panels and things that I sit in, we have, and I'll use the term middle class. The middle class answer to this all is, well, we just need more financial education. Well, if in fact you didn't do very well in school, it wasn't a pleasurable experience, how do you think you're going to get somebody back to come and sit in a classroom and learn about something in a future state, right? Where your problem is of the moment or just in time. So it is not the silver bullet of everything. I can give you an experience. You're citing case study, which I think is really good. We have a partnership with Lutheran Social Services in our Eastside Financial Center, where we have people that just come in and talk about financial budgeting and counseling. And while their primary goal is to deal with a financial issue, what really ends up happening is they may have a daughter who's pregnant and is a teenager, and the fact is now they need to navigate the county health system in order to get benefits to make this thing work. And so the budgeting and counseling aspect is the reason they came in, but the real problem is some fundamental underlying issue, whether it's health or whether it's emotional. Those things are harder to deal with. It's a lot less straightforward as to debits and credits, if you will. It's dealing with humans and emotion. The one thing that I would say when we're working with people every day is don't have pity. The people that we work with are incredibly resilient and smart. They just have a tendency that they're living in a planning phase, which is right now, as opposed to a lot of it, in some cases, is paycheck to paycheck. And maybe for most people in this room, it's, we think of budgeting and planning for the long term in retirement. And so as a result of that, decisions get made differently because there's different criteria, but it doesn't mean that this person is any less intelligent. They're just dealing in a different set of circumstances.
And to play off that, this is one of my biggest frustrations with our kind of fellow fintech companies, right? You just talked about really meeting the individuals that you serve in a really personal way, and in a very intimate way, really understanding what's going on in their life. And in Silicon Valley, we have this mantra of like talk to customers, talk to customers, talk to customers. And it seems like fintech firms just completely forget that, and it doesn't make any sense to me because more than almost any other sub-industry of technology, that's where we should be doing it the most. The very first hire we made at Even was a user researcher. It was not a popular choice with our investors. They wanted us to hire an engineer. But she has ended up being an incredibly foundational part of how our product has come together. Every day when our team, rides the BART into our office, they're listening to a podcast that she put together, which is interviews with the people we serve, talking about the features that we're working on building that day, right? And so that kind of connection, I think a lot of companies miss out on. And that means you end up with these questions on panels like this of like, well, why is fintech paternalistic? Well, it's like, well, because you're not talking to the people you serve. And so I think that's something that the industry as a whole could come a long way on. I see some progress. I see people starting to think about this more. I see people copying us and hiring user researchers early on, which I'm totally fine with. But I'd like to see more of that, and I'd like to see more of that type of engagement.
So between fintech firms and traditional banks, who do you think will ultimately provide better financial solutions for consumers?
I'll take a whack at it. I think fintech will. And the reason I say that is we've got to move the model. I can't honestly sit here and tell you that a checking account will save somebody's life. It doesn't. And because they have a certain financial product, it means that they're somehow banked or they're somehow saved or something like that. And that is completely a myth. We need better designed products that serve people where they are, when they want it, how they want it, and it needs to be in a form that they can understand. And I would say one other thing that impacts this greatly is, now Rachel had a caveat to this whole thing. She didn't want any fluff answers. So I'm going a little beyond my skis in terms of honesty here. But the fact is we work in a bit of a baby boomer mindset in terms of how we look at the world. And the fact is when I have a conversation with my kids, they look at the world completely different. And so I think there's a place for banks. I really do. And good community banks of how you might think them. But the fact is we need new financial services and products that really help the health and financial wellness of a consumer and customer.
So when I think about the products that I use every day, all of them were at some point, financial products, all of them were at some point fintech, right? Like when I swipe my credit card, that's technology. When I go check online banking, that's technology. So I think that, looking at a point in time, sure, there may be some things that fintech is doing that incumbents are not, and vice versa. But when you look at over a longer time horizon, when you look at the evolution of the industry, I think what you'll see is that the best ideas are going to get incorporated into the incumbents that have the ability to reach the largest number of people. Even can only reach right now a very limited number of people compared to the number that you can serve. And so I don't think there's an either or question quite so much. The question is one of timing, of trajectories, and really how the two parties work together throughout that time.
A lot of partnerships as well that between banks and fintech companies that I think are really promising. So, for instance, Citigroup uses Lending Club to help fulfill its Community Reinvestment Act mandate, in part because, again, Lending Club is really good at reaching people in all areas and places that their branches may not reach, right? Citigroup's branches may not reach. And so I think those types of partnerships that you see emerging are, I think, helping drive more innovation and probably better services for borrowers and for investors.
So I think the jury's still out, and maybe the jury will be out for a long time. Banks have a very special place in society. They're critically important to society, and they are large institutions that take some time to move into different areas. And as I was saying before, fintech companies tend to focus on niche products in niche areas. The one advantage that, and reach, as Quentin was saying, is super important, right? So for our product today, it's very difficult for a small startup to get their product into every single bank in the United States, let alone just the larger ones. So that reach, the incumbents definitely have an advantage with. I think the banks have, I guess I'd call it an escape valve, so to speak, in that at the end of the day, if a product is particularly attractive, they can do something really neat, which is go buy that company. Or they can go invest and build that product themselves. And a lot of the larger banks talk openly about that, which is that, hey, this is really an important product and it's changing society. We'll just go acquire it, and we'll just go do it ourselves. If they miss that, or if a lot of them miss it, then fintech wins. If they don't, then the banks likely win.
So to ping off of the partnership, how do you know who to partner with? And on the flip side, what keeps you from partnering from whether it's a bank or a fintech?
I'm happy to go. We do this a lot. So in who to partner with is always a huge question, and we've made more mistakes than I'd love to admit. But the fact is, the first thing that we really have to do is make sure that there's a values alignment. If we don't share the same values, if there's a company who's looking to rape and pillage, that's just that's not us. We are for shared success. We want the fintech company to do well. We want the consumer to do well. We want the bank to do well in a relationship like that, all in a regulatory compliant way. And so part of that process is the value around compliance. In the products that we've had over our history, we generally find that compliance wins the long-term game. If you're going to shortchange that, you're going to get caught and you're going to have issues and mistakes. And so from there, we look after the values alignment. Obviously, we do the due diligence like any bank would in terms of all the compliance that we have to meet. And from there, it's a push forward to trying to make sure that thing gets done. And quite frankly, I disagree a little bit down when I hear that big banks are going to go buy fintech. I think the entrepreneurial spirit in the fintech gets crushed and lost, and it gets muttered in a huge bureaucratic type of, and I think the energy and the beauty of the product dies. And so, and maybe I'm just promoting myself in a weird way. They say, deal with a more entrepreneurial bank because we want you to do really well and be here for the long term and have that success. It may not be the immediate exit that you need, but when we're looking for partners, we're looking for people who have a little bit more long-term trajectory.
From a fintech company's perspective, as we look to partner with banks, our perception is that the first thing, and this is a little bit about what the panel's about and the day's about, the first thing that banks look at and think about are compliance. It's just everything is driven by compliance. It's about compliance risk. It's about your particular policies around compliance, your vendor compliance. It goes on and on and on. And I think that's part of the question here, which is, should that be the way that it is? I think what we're talking about a little bit here is should the bank be focused on whether this really helps people, whether it's a good product for the bank, it's a good product for its consumers, or just consumers, whatever particular area that they're working in. So I definitely believe that the banks have an upper hand, so to speak, in that there's a lot of fintech companies that want to work with banks, and if compliance is ruling the day, then it's they get to pick, or they get to figure out who's got the best compliance programs, or work with those companies to improve their compliance programs, and that makes it really difficult for small startups who have limited resources to be able to build those compliance programs up. Anyway, yeah, so that's it.
So this is the number one question that I get from founders of other companies that are maybe like a little bit earlier stage than we are. And what I think the reason that this always gets asked, the reason that we talk about it up here, is that a lot of fintech companies don't view partnering with a bank as the same as any other type of partnership or sales process, right? You spoke to a little bit of the compliance and the things you need to think about. We did not see this as a big challenge because, quite frankly, we just approached it the same way we do pitching investors or pitching new partners, right? We set up a process, we figured out what the needs in the market were, we figured out who were good kind of candidates to work with, and we went out and worked with them. And that involved putting together the compliance documentation they needed. That involved, making them comfortable with the fact that we were going to be a good partner for their bank. But I think, and this gets into a disconnect between the technology companies and the incumbent banks. Fintech companies often kind of have this expectation that the bank is going to be like a utility for them, right? It's like turning on the water or like turning on the internet in your office. And that's not how it works. It's a partner just like anybody else. And so I think that kind of rigor and that approach to really thinking through how you want to partner with the bank is what's missing and why this is a topic of conversation.
Well said.
So compliance is obviously one of the most challenging topics that I always hear at fintech and banking conferences. I want to dive a little bit deeper. What has been the most challenging rule, regulation, requirement that you've faced in the last year? What specifically has been the hardest to comply with?
The single biggest challenge for us is not any particular rule or anything like that, or even in one organization. It's uncertainty. Each time that you're taking a step forward as a startup, you kind of think about activation energy, right? So you're like a chemical reaction. It's like, what do we need to get to the point where we can raise money, that first seed round? What do we get to the point where we can have that first enterprise customer, so on and so forth? And the uncertainty that the current regulatory environment injects into each one of those stages just makes that activation energy requirement just a little bit higher. And we have a group of us up here on stage who have largely surpassed that, at least a couple of the first steps. But the people that don't ever get over that first hurdle are not up here talking about what they're doing because they're not doing anything. They're probably working for Google or Facebook or God knows where. And so I think that's what gets lost and that's what gets missed is this idea that it's the unknowns and the fact that as a founder who does not come from a financial services background, you really often don't know who you can even sit down with to get these questions answered. The titles of the people that ended up being most helpful to me early on were like totally opaque, and like I would have had no idea that they would have been like that useful, right? And so I think that transparency is something that's really missing and is causing us to have fewer innovations, especially fewer consumer-friendly innovations than we would otherwise have.
I'll reference something that's not regulatory, but it's government, and it's really, I think, holding back the sector, at least in the lending space, a little bit, and that's the IRS. So the IRS has a great amount of every taxpayer's information, and taxpayers empower the IRS to share that information with third parties all the time. Unfortunately, so far, the IRS has not modernized its process to be able to share that key piece of information, which is a form called the 4506T, which is your sort of summary of your tax information with a third party instantaneously. So even if they made that one change, which would be basically cost-free, the people that are online who are trying to verify that somebody's income as reported is actually what their income is and that they didn't create a false filing in order to apply for a loan, they would be able to do that verification instantaneously, and that would, again, help improve both the accuracy of the information that lenders are trying to use to improve borrowers, and then if that information were more accurate, they would be able to offer people better rates. So I think that built into online lending, unfortunately, is a bit of a fudge factor around the possibility that people are committing fraud. If the IRS could modernize its processes, that would make an instantaneous boost for the sector, and it's applicable in student loans as well. So people are now eligible for income-based repayment in student loans, but every year they have to go back and prove that they have low incomes by filling out reams and reams of paperwork and waiting for days and days and days to get the IRS to release information that the IRS already has and is empowered to share. They just simply don't use the technology that would allow it to be instant. And so rather than, I think there's obviously regulatory issues that are at play in lending, as all lending is, but those kind of issues with the government would really help foster innovation, and that's some of the work that we're going to be doing at the association.
I think one of the big dilemmas that a lot of fintech firms in Silicon Valley talk about, not just fintech firms and a number of other startups in a bunch of different industries, is do you embrace compliance, or do you act now and beg for forgiveness later? And there are a number of companies that have taken both routes. My advice and what we chose to do is to embrace the compliance aspects of the industry. It becomes a competitive and comparative advantage. I think the challenge for all of us to figure out is how do we ensure that those companies that are making the right decisions aren't getting penalized for that. And so I'll give you an example. I have a friend who, before they got funded, and that's always a challenge, you got to get it to product market fit. And in a fintech space, it's difficult to product market fit if you choose to embrace the compliance components of it, because then you need resources to do that. And the only way to get resources is to actually test the product out. But you're not allowed to test the product out until you get the compliance aspects done. And so it's a chicken-egg kind of problem. So I had a friend who tried to start up a new age mortgage servicer company. And what ended up happening as they looked into the regulations is that every single state has their own set of compliance and regulatory requirements. They had to apply for a license in every single state. And the geographical boundaries that once existed in the United States or with the internet economy are virtually gone. And so if you're going to start a business like that, just focusing on California and applying for a license in just California doesn't work. You need to be able to be in the majority of states. And if you have to go to every single state, spend 6 months and hundreds of thousands of dollars, if not millions of dollars, on legal fees and otherwise on licensing fees, it's untenable.
So with that being said, where would you guys like to see the regulators head in terms of fintech and fostering financial innovation without creating more risk? But at the same hand, where do you fear they would head?
I'll take a whack at that one. So again, not the fluff answer. The talk has been about around a fintech charter. Personally, I think that's a bad idea. And again, it's coming from, I don't quite understand the intent of the regulators as to where they are going with that concept. If that concept is coming from a place of we want to see better products for consumers and small businesses, or if it's coming from the standpoint of we want a direct pipe and control over more fintech companies, and we're not only going to do it directly through them, but through the banks that they go through. Ultimately, I think that hurts the innovation at the fintech level. You just have more layers of compliance. Now you have multiple regulators. Your bank is the pseudo one, and maybe one or two, depending on the size of the organization, as to who the potential regulator is. In my opinion, let fintechs be innovative and creative. Let the banks do compliance, and if they can't do compliance, don't let them be in that space. The fact is all the regs are set up there today, but I think there does have to be a bit of a sandbox in order to facilitate innovation. And the regulators are looking at that. I again think that's a challenging place for regulators to go. They can say they're going to have a little space and a little group that does innovation, but if you think about it, in my world, I mean, culture eats strategy for breakfast. If you have a little strategy of innovation in a sea of risk-averse people, it's not going to last, or it's not going to grow or foster or have any power. The fact is that it needs some independence, it needs some space, and there are times when products and services are just getting launched where you really need to test them. In my world, we test them on our employees, so we'll roll them out to the employees. Even then, that's a test environment we might get criticized for, even though it's very controlled.
I mean, I would say that there's a kind of a stark divide in regulation between do you have FDIC insured deposits or do you not? I think that if you do and the taxpayer ultimately potentially stands behind guaranteeing your account, then there's a significant interest on the part of the government to impose prudential and compliance standards on that entity. If, on the other hand, you're in the business of, enabling, some other, financial activity that doesn't, again, put the taxpayer on the hook, then I think, there is an opportunity for regulators to potentially foster innovation, either through a charter or through another means. But again, I think that's sort of, if the regulators will look at it through that lens of, is the taxpayer ultimately on the hook? That can help drive, I think, a lot of the way that they can sort of make sure that it's a sort of a potential promising avenue.
So there's a lot of good conversations about sandbox and charter and things like that. At least from my perspective, I think of those as very long-term conversations, and it's going to be a lot of work to get to that point, and that's okay. It should be. I think there's something that's much more immediate and much more pressing that we haven't talked about yet here, but is definitely an issue I think about from a policy and regulatory standpoint. Protecting consumers' ability to have access to their data and have portability with their data that they have with their financial institution, I think is one of the best ways available to us in the short to medium term to improve financial access and improve financial outcomes. So when I think about my relationship with my financial institution, right, they love offering me products and services, right? I'm exactly who they want as their customer. They want to give me a credit card. They'll probably want to give me a mortgage, although not if I live in San Francisco, so on and so forth, right? The people that we serve, though, don't have that luxury, right? Their bank is not trying to offer them a credit card. The only way that they can access the same types of services that I have the privilege of accessing in my institution is by bringing their data and going elsewhere. And that's something that there's already the ability for the CFPB to encourage and support. That's already on the books, and it's something that I don't think is being discussed enough. And I think it's the best way to protect the consumers who are currently least well served by their existing institutions.
So I wanted to leave some time for the audience to ask questions to the panelists. Does anybody have a question?
Hey, thank you all for being here. I was just interested in how you each feel about blockchain technology and how you are or are not looking to take advantage of that. Is it security reasons? I mean, there's ease of transaction issues. What do you see as the advantages and disadvantages, and how are you looking to tap them?
We've looked at it in a couple of different venues and types of different products. I think it's really cool, quite frankly. I love the transparency in it. And again, let's not confuse the blockchain with Bitcoin. Let's put that aside. That the core technology underneath, I think has fantastic applications, particularly in contracts. And as a result, I think there's a lot to be done there. And I'm not quite clear as to how blockchain, when you put it into financial privacy, comes out in the end, because it's all apparent. It's all out there. And so I don't know how to try to get our head around the regs between privacy of information and the publicness of and transparency of the data.
So I'm an engineer, like first and foremost, by education and things like that, and I love a cool new technology, and I've spent plenty of my own personal time, like messing around with Bitcoin and blockchain and things like that. But going back to the stuff I said earlier about being very consumer-centric and how we design our product and build our product, as the kind of current state of blockchain exists, there's no real reason for us to incorporate it into anything we do, right? We need to be more closely aligned with the way consumers are currently banking and currently using services. So right now, it's not something that's really on our radar. Maybe one day, obviously banks are thinking about it, but I think we would be more likely to follow on that rather than lead the way.
Yes. Next question.
Hi, Stella Adams with the National Community Reinvestment Coalition. And there was a couple of comments about fintechs partnering with banks around CRA compliance. Who's doing it and how's that working? And also, I'm the Chief of Civil Rights, and what are you all doing to ensure fair lending compliance is built in and locked into your products and services?
I'll just take quickly just the partnerships that Lending Club as a nationwide platform takes applications from all sorts of borrowers, and that means that for a big bank that has branches in various locations but may not have sufficient volume of applications for CRA compliant products, they can build a partnership with a nationwide platform in order to achieve those goals. And so I think any further details you'd have to go into the company, but that's broadly the parameters of how it works. I think the promise of, again, online lending is that all of the same laws and all of the same regulations that apply to all loans apply to online loans. That's the beauty, is that we have nationwide access, but the same fair lending standards and disparate impact and all of that applies. And so I think that all the firms that all the best platforms, like you mentioned, they embrace compliance. So they're very, very focused on embracing compliance and in actually seeing how the growing connectivity of people up and down the income platform, up and down income levels can be utilized to help actually expand access to credit and expand access to affordable credit.
From our standpoint, so we've had an outstanding in CRA for 2.5 decades. So we live in that space. So from a CRA and a fair lending standpoint, that's an everyday thing for us. We have a multicultural company. So the fact is we speak 7-8 languages just in the urban core, Minneapolis and St. Paul. And so as we do our lending, we're looking more ways to access communities that have been left behind than the opposite. And so particularly in our mortgage division, we look for customers of color and low and moderate means, and we basically have banks that come to us looking for CRA loans. Day in and day out, that's who we are and what we do.
Just as a clarification, though, it's the fintech firms who aren't insured deposits they're not graded on CRA. They don't necessarily have to comply with it, so to speak, right?
No, well, if you don't have insured deposits in branches, then some of those requirements wouldn't apply, because again, that's all tied to a geographic footprint. The entire statute is tied to a geographic footprint. But I think what we're saying is that financial technology companies and marketplace lenders especially are actually finding that they're doing such a good job of finding and reaching those borrowers and reaching them with affordable credit that traditional financial institutions that do have branches are coming to them seeking the actual access to those borrowers.
To your point on the policy of CRA, desperately needs to be overhauled. In my opinion, we should throw it away and start over, because there are just some things that are, not from a concept standpoint, but for example, one of the antiquated things of CRA is you have to have a paper file in your main branch. Well, why not just put it online so someone can see it 24/7 anywhere they are and look at it on their phone? I mean, so there's some things about it. The core of CRA, I think, is valid and critical. And I think from that standpoint, the geographic aspect of it is starting to break down as well. Yeah. Yep. question.
That they're reaching, we want to make sure
Yeah.
that they're reaching the right people with the right products. We have horror stories about marketplace lenders who are raping and pillaging women, entrepreneurs like me. When you talk about the average American, was I your face, an African American small businesswoman? And if I wasn't, I can tell you that the marketplace lenders are charging ridiculous prices, and I don't have access to affordable credit through a financial institution.
Gotcha.
But I'm in place now.
Okay.
We're looking. Just want you to know.
Thank you very much. We have one more question in the back, 1 minute left.
This is mostly for lenders directly, but I noticed for the Marketplace Lenders Association, you said that banks are coming to you a lot to seek out customers that they wouldn't otherwise. I mean, I look at the data and you look at the big players there. You look at SoFi, great loans for great people, or some of the other guys, and they're trying to single out people with higher earnings potential because of underwriting that's education heavy or something like that. But when you look at the originations by credit score, they're about the same as traditional finance companies. What do you guys think needs to happen in order to provide credit to the underserved who are highly reliant on alternative financial services? Because the traditional consumer loan, a product of 1 to 5 year maturity, $5,000 to $35,000, that simply is not a good product for a large proportion of the population. As the woman who just asked a question mentioned, there are a lot of folks who just simply can't access credit. And when I look at a community bank like your institution, you're better at serving those unique customer needs. And how do we sort of commoditize that relationship lending? Do you see any obstacles to doing so currently there? And do you see any companies that are really making that leap?
I mean, I guess I would say I think the marketplace lending space, as we define it, is all sub 36% APR tech-enabled lending. So some of the high-rate products and payday loan products we don't consider to be marketplace loans. So that's first. So we're focused all in the prime and near prime space, and at affordable rates that are helping people save money compared to the traditional alternative. So if you think about a minority-owned small business that might have a credit card from a bank, the typical rate, if they can't pay the full balance, might be 24%. If you go on, our members' sites, you're going to be refinancing that somewhere in the mid-teens often, right? So not only are you not continuing to pay interest on a revolving balance, you're actually getting an installment rate product and reducing your rate by a third, according to a recent large survey. So to us, I think the way we see the promise of marketplace loans is in, again, expanding access to affordable credit. Completely agree with you that there are a ton of people out there who deserve and qualify for better rate products, and they're ending up in very high rate products. And that's a kind of a market failure that we think technology is well primed to serve and solve. And I guess I'd turn it over to
I'll give you a 5-second answer, and that is, so we partner with a fintech out of San Diego called Employee Loan Solutions. So and basically offer a small dollar loan product through employers as an employee benefit. So they can access credit that is unsecured as opposed to entering and building their credit history in a secured environment. So we think the employer channel, for example, is a place that you can do that in a safe space.
To say a 5-second thing as well. Stop trying to shrink the existing products down to the right size for a lower income consumer. Design new products that actually fit their life. That's my mantra. I'll keep saying it. I've been saying it, but that's what needs to happen.
Great. Well, please join me in thanking the panelists.